Alright, welcome to Mastering Option Selling 2.0. So in this video, we'll discuss about ratio spread. So I'll show you exactly step by step how we deploy and when we deploy and why we deploy that strategy. What is the certain criteria we are following before we deploy this strategy. So first, you must know when we are going to deploy this strategy, IV environmental should be higher and the market should be neutral or slightly bearish or bullish according to that direction. So when we deploy a ratio spread, when market is neutral or directional outlook, and we anticipate the asset price will move slightly or in a directional. So that is the main criteria. What is the strategy and how we select the strike price? We sell two lots out of the money put or call according to that direction and buy one lot higher strike price with the same expiration. Remember, the expiry should be same. So let me show you exactly how we select the strike price. Okay, what optimal technical pattern we use in a ratio spread. So in that case, I use 3 EMA, that is one is 5 exponential moving average, another 75 exponential moving average, and another 383 exponential moving average. So when 75 EMA stay above 383 EMA, that means trend is up. All right, so means we are bullish. And where is our entry point? When 5 EMA cross any EMA like 75 or 380 EMA, that is our entry point. Let me show you. Okay, let's see. This is resonant turbo. Here I can see this is H1 chart. So basically we use H1 chart, and this is 383 exponential moving average, another 75 exponential moving average. Let me show you here. Okay, this is 5 EMA, this is 75 EMA, and another 383 EMA. So you can see when 5 EMA cross, so after that price are running toward the upside. Now you can see cross this 75 EMA, that is our entry point at the time we deploy that strategy. So after that price is running toward the upside. And same scenario we have seen, price cross and we anticipating that price will go up. So that is our entry point. Step 2, use ratio spread. Some criteria are there. Before we deploy that strategy, we have to ensure implied volatility percentile is more than 40 to 50. All right, and always ensure earnings not within expiry. Let me show you where we will find this implied volatility step by step. So in that case, you just go to Opstra, and after that you click on option. Here you can see this is option. Click on here and go to option dashboard. That is the 4th column. Click on there, and after that you can see there table view, and this is the title view. So you click anywhere. All right, so let me click on table view. After that you click IV percentile. Here you can see. So now you can see first you can see which have more implied volatility. So it's arranging like that. So here you can see we deploy that is LT. Let's go to LT. Okay, now we can see this is LT, and here I can see implied volatility percentage above 40. Okay, So another here you can see this is the liquidity. We need a high liquidity. Another here you can see bell icon. So once bell icon green like that, that means they are going to release earnings. So we have to avoid this type of stock. But LT, there are no earning going to release before expiry. So when it's going to expire? It's going to expire 25th May. All right. So means from 16 to 25th, there are no earning release. All right. But NTPC or other company where you can see like PNB, they are going to release the earning before expiration. So that is why we have to select that stock who is not going to release their earning. All right, we complete the first criteria. So second criteria, choose date to expiry near 30 days ideal. So basically, when we are focusing on sell side, so in that case, we are selecting below 30 days, not more than, because if we select like long dated option like 45, 60 days, their theta decaying very slowly. So if we select like below 30 days, the theta are decaying very fast. So this strategy we are purely focusing on theta. So that is why we are selecting below 30 days. So basically I prefer 20 to 25 delta, which give me 75 to 80% winning probability. Let me check it. Let me show you how exactly I select this delta. So here I can click on there. Now I can see this column called option chain. Click on here and select near recent expiry. So 25th it's going to expire. So let's say here, according to this technical pattern, price will slightly bullish. All right, so that is why we will protect upper side. Remember, we will protect upper side and the downside will undefined risk. But remember, we'll adjust later if we are wrong, or if price goes against, we will adjust the position. So let's say here, when we deploy somewhere here after crossing this level, upper side is purely risk free, but the downside is undefined risk. So here you can see price goes up, no need to do anything. If price goes down, or if price goes down, we have to adjust. Okay, let me show you how we select. So basically we select. All right, once we get the confirmation, so how we will deploy that strategy, let's check it. So here you can see I use Opsta to analyze this trade. So here write LP, so we already place here. So once we place LP and go to option chain, so once you click, so select near expiry. So basically we use 25 delta. So here you can see this is delta. All right, put delta. So why we use put? Because we are bullish. All right, so bullish. So that is why we are focusing on sell side, which means we are going to short put. So how many lot we will sell here? 20 delta, 25. All right, sell 2 lot, add position. And after that, you can see that was 12, 25th delta. So one strike price above. All right. So means we are going to buy one strike price higher by how many lot? 1 lot. Add position. Now see, it will look like here. So upper side is risk free, but in a downside, undefined risk. All right, so now you can see here, this is 52.71% probability to it is a winning probability, and maximum profit if price close exactly where we sought around 2181. So we will get 8,415 rupees, which is 7.37% of my entire capital, which I already deployed. Okay, so and another, that is break even point, it's a 2152. Let me show you 2152. Let me draw a horizontal line, 2152. Okay, this one. So this is my break even. Means if price goes down and close below this level, so my loss will be there according to their lower point. All right. So if price close above from this point to anywhere toward the upper side, we will be profitable. All right. So that is the beauty of this strategy. So as I said, long call strike, price 1 or 2 strike above short call strikes. So basically we use 1 or 2 because it is based on implied volatility percentile. If implied volatility percentile is too high, so we are using 2 strike price above. Now you can see implied volatility is slightly higher, so that is why we are selecting 1 strike price higher. Remember, 20% of max loss is a 2% of net liquidation. So how much we are taking risk? Only 2%. If our loss is more than 2%, we will close the trade and we will come out from the market. We are not going to take more than 2% our net liquidation. Take your potentially lost or profit at a different price. So when price is moving, so you just check it. What is the profit and loss? So 15 days to expiration and at expiration. So if how much profit we are getting within 15 days and what will be profit at expiry. So if within a 15 days, if we collect 60 to 70% premium, we will close the trade. Another thing, ensure ask and bid spread of option not more than 0.4 to 0.5. Let me show you how you will check this one. You have to visit option chain, NSC and SC, option chain, and click this one first, option chain. And here you can see select symbol, because when you are we are selecting like indices, Nifty or Bank Nifty, Fin Nifty, you just go to this column, and when we are going to check option chain data, you just click on here, write LT. So here you can see this one LT. So when we deploy that strike price, when we are selecting that strike price, so basically which strike price we select, now you can see sell side 2180p, go to here and check 2180p. So here you can see ask and bid price, not this one, second and third column. You see what is the difference between? Only 0.10. That is good. Okay, and another we select that is almost you can say like 30 point. All right, here you can see another ask and bid price difference, only 0.30 here. So I think 0.30. Okay, so always check if ask and bid is more than 1 rupees or 2 rupees, so don't place that order. Why? Because of spread. All right, so here you can see one thing, What is the lot size here? So now check it. Here you can see this is the lot size, 300. Let's say if there are 3 rupees ask and bid difference, means when you will place the order, automatically 900 loss will be there because of ask and bid spread. So that is why we select 0. Maximum 0.4 to 0.5. All right, if like 0.5, so 300, so 150 will be minus there. So spread the cost will be 150 rupees only. If there are 3 rupees or 4 rupees, according to that, so we have to pay that much. So that is why you select that strike price only. Trade and risk management. Monitor your trade performance at least once a day. So no need to observe or monitor every time. You just check it once or twice in a single day only. So when the delta of your short call goes above 0.35 to 0.40, you have to adjust your trade, or if there is more than 50 days to expiry. Remember, so let's say we place order like first of this month, and your delta goes like within 10 days, 45 to 60, whatever. So you need to adjust. All right. If there are like less than 15 days to expiry, if delta goes beyond that one, you just cut the position and come out from the market. All right, so how we will check the delta? Okay, let me show you here. Okay, that is our position. All right, so this is our position. So click on Greek. Now, what is the delta? So now you can see delta, it's just showing put buy is a 30. All right, but put sell is a 50. That means there are 2 positions are there. So if you divide, that means 25 delta each, and this one 32 delta. Okay, so if this delta goes like more than 40, then you need to adjust if you have time to expiry, or if you don't have time, like 10 days or 6 days or 7 days to expiry, close the position. Do not let the delta go beyond 35 to 40. Okay. This way your limit risk. So this way you limit your risk to 20% of your maximum loss. Otherwise, there are undefined loss. So what is the advantage of a ratio spread? What is the risk? So advantage is like high probability winning. So we have seen more than 80% winning probability. And this is a highly benefit from a theta decay because of IB percentile is high. So profit from the stock's price move sideways or down or upper side. But price should not go beyond our break-even point. So that is the important we have to monitor. Disadvantage is only like maximum profit is capped at a premium collected. So what premium we collect? So that is the maximum profit is capped.